Welcome back to the channel where we give ourselves a raise and live our ultimate sweet life through smart financial decisions. And today we're talking about how I analyze an ETF, otherwise known as an exchange traded fund, and how you can build your portfolio up well over $1 million and be able to make that decision. Do I retire early or do I just enjoy that millionaire lifestyle? So last week I did a video on stocks and how I select individual stocks. I have a 10-step program on how I look at a stock before I actually hit the buy button on that stock. If you want to check out that video, I'll link it right up above as well as down in the description below. But today we're going to talk about a 5-step approach to an exchange traded fund. Now, when we look at a single stock, let's say, pick your favorite one. You got Apple, you got Tesla, whatever, just pick your favorite one. And you want to build yourself to a $1 million portfolio, so that's what you start doing. Every week you invest whatever you can invest into that particular stock. But then, all of a sudden, something bad happens. There's a bad innovation in the company. There's a bad balance sheet. Financials go amok. And all of a sudden, your capital gains, your dividends, and your stock price all fall down. The company practically goes out of business. And because you put all your eggs into one basket, you know what happens? Your eggs crack. An ETF, on the other hand, sure, it has maybe your favorite stock in there, but it has hundreds of baskets, sometimes even thousands of baskets that you can have all your eggs in. That way, if one of your stocks goes down, the ETF might go down a little bit, but it doesn't all come crashing down. So the cool thing is an ETF, by just buying one share of one ETF and building up those shares over time, lets you diversify within the ETF itself. And over time, you can build up and build up and build up to your $1 million portfolio with the power of compound interest. So let's break it down. Let's get into the 5 smart steps that I use before I hit buy on an ETF. Now, why only 5 smart steps compared to 10 smart steps when we were looking at stocks last week? Well, with ETFs, we pay them a small expense ratio. And because we do that, we expect them to manage that either passively or actively for us. We don't have to dig down and dig into each individual stock and do analysis. God, we'd be doing that forever. It's a little bit more of a risk-free way. And because we're looking at it from a more broad perspective, there's really only 5 steps you need to look at before you hit buy on that ETF. So let's get started with smart step number 1 when it comes down to ETF, and that is your theme. Now, typically, I analyze each smart step with a red, a yellow, or a green light based on how that particular smart step performs after we look under the hood and make sure that the engine isn't rusty. Well, if I look at number 1, it's your theme. So your theme is based on you, your passions, and what you're most interested in. You might be interested in electric vehicles. Maybe you're interested in aerospace. Whatever it could be, that's up to you. What you like, some people might not like. So you got to do your own research on what you like with your theme. So your theme could be your industry, the sector that you're interested in. Maybe you want a bunch of growth stocks. Maybe you want to invest in international ETFs. Maybe you want to invest in bonds. It's up to you what asset class, what sector, and what industry you're interested in. But here's a good resource, and of course, a free resource to use. ETFdb.com. Go check that out. That is a website where you can do what we call a screener. You go through, you look through the different industries, sectors, and asset classes, and choose what best fits your goals and best fits your passions. Because you got to invest in something that you know and understand at least a little bit. Comprise a list. After you go to etfdb.com, comprise that list and bring it forward, because now we got to go through smart steps 2 through 5 to see which ETF is best for you. Smart step number 2, expense ratio. There are 2 types of ETFs. You got the passive ETFs, which basically track an index. They're looking for an index and trying to maintain their focus on that index. And then you have actively managed ETFs. And you have an active manager who's buying and selling shares in that ETF. And because they're actively doing that on a regular basis, the expense ratio can be a little bit more. And I'll give you an example of that in just a minute. Now, me personally, I like to invest in passive funds, something that I can set and forget. My goal is to retire early. And in order to retire early, well before the age of 65, I want to make sure I have something that I can just simply cut out of my budget and invest on autopilot and let that grow over time. And as long as the stock market is rising over the long period of time, remember, over the historical average, the S&P 500 has grown by 10% on average. So if I can maintain at least that, I'll be well on my way. So that's why I kind of aim for more passive, because I can cut down on the expense and set and forget. So how do we check for the expense ratio? We go over to seekingalpha.com, one of my favorite free websites to use, and I'm gonna choose one of the ETFs that I know about, not financial advice, I'm just gonna choose one that I know, which is VOO, and this is the Vanguard S&P 500 ETF. Now, as you can see here, you got a lot going on. You got the stock price at $386 a share. I'm actually gonna take you first over to the right-hand side, and that's where we find the expense ratio. Look at that, 0.03%, which means for every $1,000 you invest into VOO, you pay 30 cents per year. Now, expense ratio does not mean that they're sending you a bill in the mail, that you gotta write a check or something like that and send it back to them every year. This is actually taken out of your portfolio balance based on what you invested. So technically, you don't always know that you've been charged, but don't worry, it's there. And that's why it's important to know what your expense ratio is. Now, for a passively managed fund, that's phenomenal. I've seen anywhere from 0.03 all the way up to 0.4, 0.5. I don't like to do anything above a 0.3. So 0.03, you're looking pretty good. You're looking like you got a green light on your expense ratio. 30 cents for every $1,000, nice. Now, let me compare that to an actively managed ETF like I shared earlier. A lot of you may know and may be familiar based on other YouTube videos or doing your own research about ARK Investments, managed by Cathie Wood. So remember our 0.03. I'm going to pull up one of her funds, ARKK. This is the Innovation ETF by ARK, but look at the expense ratio. 0.75%. Compare that to our 0.03. You got to make that decision. Are you okay? Do you like the idea of what Cathie Wood's doing? If you do, that would be okay. Maybe look at some other funds, some other innovation ETFs that are actively managed to see if this is the best price compared to the competitors. That's a good way to look at your expense ratios. Why overpay for something that might be doing just as well with another ETF? Now, you might also say, well, I'll just look for the lowest expense ratio and go all in. Well, be careful about that, because we don't want to just do that. We want to make sure that our ETF is actually performing like it should be, whether it's passive or active. We want to make sure that if it's tracking an index, that it's trading well and it's trading with efficiency. And that leads us to smart step number 3, which is tracking comparisons. We want to see how is our ETF doing against the S&P 500 or whatever index it is tracking to. So let's hop back over to seekingalpha.com, and here's my Vanguard S&P 500 ETF, VOO. I'm going to scroll down and scroll down and scroll down, and what I'm looking for specifically is momentum. I'm going to start with that first. And I want to see how is it going up against the S&P 500. Now, this one in particular tracks the S&P 500 index. So how's it doing here? So you can see within the last 3 months, 10.45 against 10.31. So actually, it's not only just meeting the S&P, it's exceeding it by just a little bit. But I don't really care about 3 months. I care about 1 year. You can see it has a 38.65% against the S&P 500 at 38.76%. Hey, that's pretty darn good. It's tracking to what I expect it to track. With a 0.03% expense ratio and its momentum compared to its tracking index, I'd say that's pretty darn good. Another thing you can do in this smart step is compare it to some of its competitors. Now, what I do, I can actually open up Google and just do it this way. Competitor to VOO. So here's some other ones. Here we go. We got the SPDR Portfolio S&P 500, SPLG. So what I'll do is I'll come back over here to Seeking Alpha, and then what you want to do is click on Advanced Chart. I'm going to click on that, and here is our chart. Now, right now, we're only looking on VOO, but we want to add in what we found over here on Google, which is SPLG. So you click on Compare, located right there, and then it's going to pop up this box right here. And I'm going to type in SPLG. And there it is. Click on that. And now let's see how they're doing. Okay, so look at this. They're both doing pretty darn well. You can see indicated by the dark red here is the SPLG. And then you can see the orange is VOO. But you can see they're kind of right on each other. Let's look at SPY. There's the SPDR S&P 500 ETF. I want to see how that one's doing. A lot of people talk about SPY, so I'm going to hit compare, and I'm going to type in SPY, and there it is. And there she goes. So now look at this. You can see indicated by the light blue compared to the orange. They're kind of right on top of each other. This is another good way that you can track in Smart Step 3, not only how it's tracking its index, but how is it compared to its competitors. Is it doing around the same? Is it doing a lot more, which would be great? Or is it somehow doing a lot less? Especially in the actively managed funds, it's really important to look at this because you want to make sure that if you're spending your money, if you're investing in this ETF, that they're doing what they say they're going to do for you and that you're maximizing your growth. Smart step number 4 is its overall holdings related to smart step 1. Of course, your holdings is based on your theme. So if your theme was, I want to just have a nice growth S&P 500 like VOO, I want to see what kind of holdings does this thing have, just to understand it. It's always good to understand what the ETF really is. So right here on Seeking Alpha, I'm going to scroll down and I'm looking for the holdings breakdown first. And you can see here's what we got going on within this particular ETF. We have 23% on technology, 14% on financials, and these are basically the different sectors. So that's all cool. You can see that we have a lot going into technology, a little bit going into financials, a tiny bit going into real estate way over here on the right hand side, but that's kind of how the breakdown is. And then what we can do is we can look at the overall holdings. Now, here are the top 10 holdings of VOO. You got Apple, you got Microsoft, Amazon, and a lot of companies that you probably have heard about. So not too bad. And remember my example from earlier. Let's say Apple all of a sudden falls apart. God, I hope not, but they might. If they ever did, you have all of these other things. In fact, look at this down here. You have 509 total holdings within this ETF. That's basically potentially 509 stocks in this ETF. So if Apple goes down, even though it's 5.87%, it'll dip a little bit, but it won't completely crash. Why? Because it has a little bit of diversity within the ETF. And of course, for my dividend lovers, even though this isn't part of this particular Smart Step and Smart Step 4, I will say that this one is kind of nice because it does pay a dividend. Not all ETFs do, but this one does have a dividend yield of 1.4% with an annual payout of $5.39 per share. Not too shabby for an ETF. So that is Smart Step 4. Just look at the holdings, look at what it's invested in, and make sure that it matches up with the theme that you thought it was. Let's say your theme is aerospace and it's only investing in electric vehicles. Where's the connection? Maybe Tesla, but I don't know. Just do some digging to make sure you're comfortable with that. Now, of course, because I'm comfortable based on what I'm doing with the VOO and the S&P 500, Smart Step 4 would also get a green light. And so far, VOO is 4 for 4 for me. Not too bad. Last smart step number 5 that you need to look at when you look at your ETFs is the turnover rate. Now, what the turnover rate means is how often are they turning over their assets. So you're going to see typically your actively managed funds are going to turn over a lot higher than a passively managed fund. This is important because you can get hit with taxes. ETFs are usually known for their tax efficiency, which means that they have great opportunities to build you wealth without slamming you with a bunch of those terrible taxes that we all hate paying. So what you want to look for is how much are you at risk for capital gains which are taxed. So unless these ETFs sit in a Roth IRA or some type of tax shielded retirement account, you are subject to taxes on capital gains. But with tax efficiency, that should help you. So right here on Seeking Alpha, I'm going to scroll down to the bottom. And what we're looking for specifically on this one is under risk. Right here near the bottom, you can see the turnover is 4%, which is next to nothing. That is a very low percentage of turnover. They're not turning over a lot and typically a passive fund shouldn't, which is why it's tax efficient, because you're typically not going to have to pay much, if at all, taxes on this particular ETF for capital gains, especially if you hold it in just a normal brokerage account. So that is not bad. Compare that to ARKK, our ARK investment that we looked at earlier, which actually has a turnover currently of 80%. So there is a chance that you could be hit with capital gains on the taxes if it's not in a tax shielded retirement account or something similar. So just something to keep in mind for Smart Step 5. You want to look at your turnover and you want to make sure that you're doing the best for your money. What other questions do you have? Comment down below and I'll dedicate a video to your question. And I also need something from you guys. Down below, what ETFs would you like me to put my 5 smart steps up against and do an analysis with the 5 smart steps for your favorite ETF? Comment down below, let me know which one you'd like me to explore. But until next time, here's some other videos that might help you along with your journey, and we'll see you on the next video.